All right, here we are again. I think, what is this? This is, I think, the fourth time we've met at a Zoom today. And I want to just check in with you guys like we always do. Kind of, what are you doing? What are you learning? And then I've got some trivia questions, because it's not enough just to kind of sit back and learn passively. And even though you don't have a video or audio, Nancy, that doesn't mean you can't participate in the trivia question.
Sure.
It's kind of a test to make sure that you're not a bot and that you're a real person. So, all right, you guys ready to go?
Yeah.
Yes.
All right. So here's kind of what we've done. Just kind of check in. What have you learned? Can you see my screen?
Yes.
Yes, sir.
All right. What have you learned since we last met?
There we go. Now we see it.
Yeah. Okay. What have you learned since we last met? What have you been doing?
I can start.
Okay.
So basically, my biggest thing, I learned straddles, and the poor man's covered calls. I think for me, one thing that I learned, and I learned the hard way when the market fell the last few days, was my anticipation like about a poor man's covered call was we had some kind of protection against if the market drops really fast, but it wasn't true, because I realized both of the legs that we sell are, if we're doing a bullish call, both of them are calls, whereas if it's a bearish, both of them are bearish. It's not one or the other. So when I took a Netflix trade, and then there was like a fake spike after the earnings, whenever Netflix said they were going to raise their price up, and after a market, it dropped down to like 478, and I got trapped in that trade. And I started looking at what I did wrong, and I realized that I should have had a long-term bullish call with a short-term bearish call, which would have helped me short-term not get stuck in that trade.
Actually, the short call will give you some protection because you collected some credit against it.
Yes, I did. So it wasn't as bad as it would have been, but I felt like if I had done it the other way, I could have made money short term and waited for it to recover, because that was just like a quick flash crash due to the price increase.
Yeah. All right.
So that was one thing I learned. And then there's a company called Eat. They're a restaurant company. They own a bunch of Italian restaurants and stuff over here. And what I've been following them for a while, and they usually stay within that $40 to $50 range. So that's what I did my strangle on that, and so far it's been very profitable. I've made about $1,750 on that trade.
Yeah.
And it's what I sold I felt like it wasn't going to cross 50 and it wouldn't drop below 40, and I could take advantage of that, and that was my strangle trade, and it's been working pretty good for me even when it got really bad. So that was it. And then on the iron condors, I took one trade. I don't really understand that as much yet. I want to get more better at it, but I took it on Oracle, and it's been profitable so far. The only thing that I would say maybe we can cover today is on the poor man's cover calls. When the short expires, like we were talking about it earlier today, how do I start another? Like, what's the best way to not let that happen? Should I roll it over, or should I let it expire, or should I take profits and just start over?
Well, and I'll go ahead and answer that. I like to leave a poor man's covered call on, and at some time during the last week of expiration, I like to roll it into the next month for a credit, probably to the new 20 to 30 delta.
Okay. And does the trade diff platform let you roll it over?
No, it doesn't. It's not really set up for rolls yet. So you got two ways to do it. I know you had a hard time just kind of opening up one because it thinks it's not smart enough to realize it's not part of a two-legged trade. And we're wanting people not to just buy calls or puts. And that's the reason you had to kind of put on a whole different spread. But if you were doing it in real life, you'd just either roll that one out, or if it expires on the next Monday, you'd put another short call on.
Okay. So for the purpose of trade diff, we will have to close out the whole trade and start over every time.
You know, I swear that I have closed a trade and opened another one as part of, and I'll talk to Mike to kind of see if we can get that. But if for some reason it won't let you do it, then close the whole trade and reestablish it.
Okay.
Now, if I look at kind of where we're at, here's where we're at in the contest. And I noticed that Juice Ball took a big dip. I think he took some directional plays. And the thing about direction, if you're right, you tend to make more, but if you're wrong, you can get hurt. So Juice Ball's come down to 7th place, and you've taken on 1st place. Mike is 2nd. I've made a comeback into 3rd place. Quan is no longer in it, so we'll be taking him off, and then Greg, and then Nancy. Now, part of the reason why Nancy had a drawdown, and we talked about this, Nancy, is that rather than selling the strangle, you bought the strangle. I think you took it off today. So,
Yes.
No, so this one is in fact correct. So we that's one of the things you've learned. So anything else, Jamal?
That's about it. That was the only struggle I was happening. And then the only other thing is, I would say that if you could maybe show us another example for a straddle today.
Okay.
Just so we can, I couldn't find it in our video. I think we only did examples for a strangle and an iron condor.
Okay.
So if we could maybe just do an example for a straddle, that way I could put some of those on as well.
Okay. Why don't you remind me at the end, and we'll go over that. We'll go over a straddle again. In essence, the 2-sentence answer, and then I'll demonstrate it later, is that you sell both a put and a call for a straddle at the money.
Yes.
And for a strangle, you're selling them both out of the money.
Oh, okay. So that's the only difference.
Yeah, that's the only difference between a straddle and a strangle. Now, I've suggested selling for a strangle, selling a 20 to 30 delta.
For strangle, yes.
For strangle, selling a 20 to 30 delta.
Okay.
But for straddle, you're selling at the money.
Oh, at the money. Okay.
Yep.
Perfect. Sounds good.
And remind me again, Dale, bullish, bearish, bent on either of those, and
all right. Poor man's covered call is bullish. Poor man's covered put is bearish. Strangle and straddles are neutral. Iron condors are neutral.
Right.
An iron condor is essentially a strangle with wings, and it's a defined risk trade.
Or an iron condor is just 2 credit spreads, right?
An iron condor is a 2 credit spreads. One of them a call credit spread, and the other one is a put credit spread.
Right. That's the way I identify with them, and I actually like. I intend to use those quite a bit.
Nice. All right. Well, what about either Greg or Nancy? What have you learned since we last met?
Okay, I can go. Like the mistake I made, instead of selling the strangle, I bought a strangle.
Right.
And until you told me, I didn't know. So.
Okay.
So that was a mistake. And Jamal, I have a question. You said 45 to 50 days. Is it 50 days on your strangle?
Yes.
That you found? Okay.
Yes. So I've been doing all of them 45 days so far, just so
45.
I could just because that was giving the best price within our $5,000 budget.
Oh, okay.
So I've been doing everything 45 days.
Okay.
Tasty Trade suggests the 45 days, and the reason they like that is it gives you plenty of time to make adjustments. The thing about selling weeklies, sometimes if it moves against you, you really don't have time to make any adjustments. So that's kind of the downside. So
sorry. So like what happened to us 2 days ago where everybody dropped down really fast. what steps would you, because I noticed that you were the only one that kind of survived that downtrend pretty good. Like, what steps would you take during that time to?
Well, the thing is, I think when everybody had the big drop, you also saw volatility skyrocket. And that's a hard time for option sellers. The good thing is to have enough dry powder that you're going out and you're selling options when volatility skyrockets, because you're getting paid. When people are scared to death, insurance rates are very high. So if now you become a seller when the volatility skyrockets, then when it relaxes, usually fear is overstated. People think that it's going to be worse than it actually is. So when there's blood in the streets, when people scared to death, when the hurricane is forecast, it's usually fear is overstated. And usually the analogy I use, have you ever heard of, or maybe I've mentioned this to you before, I don't know, rodeo poker?
Yeah, you told us.
Yeah. Well, it's kind of like that. It's like the fear is out there, but the last cowboy to remain seated usually wins. So just kind of keep your cool, realize there'll be better days. Things are going to relax. People are going to realize the world's not coming to an end. And when they realize that, it relaxes a little bit. And then all of a sudden that premium comes in.
Hey, Dale.
Yeah.
If let's say you were in a situation where you're loving like the high volatility, because we get more money in our selling our spread, and let's say we sold a call spread, but the market is running away from it. It's really not the best time until it starts coming against you to sell again, right? You get what I'm saying?
Well, for a call spread, it's kind of a double whammy, because if you're setting up a call spread, you're buying one, it's not the best time to be buying something, but you're selling something else, which it is a good time to sell it. So that's the best time really to be trading strangles and straddles.
Oh, okay.
Because you're selling on both sides and not just one. See, a poor man's covered call or poor man's covered put, you're at least having to buy one side of it.
Uh-huh.
So to be a seller of both sides, you're getting paid on both ends.
Okay.
So, yeah. So anything else, Nancy?
No, that's it.
Okay. Well, Greg, what are you learning? Since we last met?
Well, I guess I'd congratulate Jamal on incredible performance. That's awesome.
Yeah.
Yeah, he's top of the game there, and it gives me motivation. Anyways, I spent most of my time dealing with again with a little bit of health issues, and now I'm coming back online a little late to the party. Did not get my homework done at all. Frustrating for me. I was telling Dale that I'm trying to focus on getting an irregular income stream. And that's why I was kind of excited, Jamal, when you mentioned credit spreads, because they're something that is near and dear to me, and I've got to get trading them. So I've focused really hard on learning the zero DTEs and setting up for that, because I really believe I'll be able to make it good there. And now I have to prove it to myself. So I'm a real visual type learner, and I have to see what's going on with these options, with these spreads, and see it on the charts. And when I deal with Thinkorswim extensively on tech support, I get these fuzzy answers, and I'm like, what the hell's really going on here? And it kind of pisses me off, because I want to know, I want to see it on the chart, man. I mean, it's got to be there. I agree that it's a calculated number, but I've been trading futures, and so I know what I know there, and I need to be able to chart it. So I set up my charts the way I needed to see them to trade SPX zero DTEs. And for me, that was a big deal, because I had to relearn TOS and push the envelope with tech support on at least 5 calls. I mean, there's been a lot of calls with tech support. And I got it set up where I can monitor the SPX on both the intraday and also the extended trading hours, 2 different charts. I use a setup that's got standard deviations on it because I heard that that was good, and I've been watching it, and actually it does seem kind of good. So I'm interested in that. I also try to trade pretty naked, basically, no indicators except RSI, and I use fibs. I've got a unique fibs setup that does tell me from my years of experience in charting it where things are going. It gives you a line in the sand, and if it goes past that line in the sand, then it's going to go the other way. But if you follow this system that this guy taught me, it's kind of cool. And so I started charting the VIX to see what's going on with it, to see if it was fibbable, if I can tell you that. And I've been watching the VIX, and it does seem interesting because it's reacting to my levels on the fibs, and I like that. I haven't run the standard deviation on that yet either, but I will. Anyways, if I have my core instrument, the SPX, and I have dialed it in, I started to take a little detour toward the ES, figuring I could trade options on it. And then through tech support, found out that, oh, you can't put in a stop limit order. You can only put in a limit order. And I'm like, what the hell? So I'm not trading something that can move like crazy. Okay. I'm just not going to do it unless I can get out quickly, and you can't unless you negotiate your way out. And if the market's cratering, like you guys saw, it could be a real difficult time. And so I'm going to stick to the SPX and trade with a limit order when I want to move things around. I created 3 charts to watch a spread on. The first on Thinkorswim would be the full spread. So you take the option code and subtract the other option code, and you get a chart. It's nice. I like that. TOS cannot show the orders on that chart, but you can also chart each separate leg, and or each separate short or long, and you can actually see the orders on there. And that was helpful to me because I want to know what's going on, where the price is on my individual option compared to the stop that I've set there, a limit order stop that I've set. So that was valuable to me. And now I think I'm ready to kick butt. Another good thing I found that I could do, I could run multiple instances of TOS. So I'm like, wow, I didn't know that. So I'm going to set up literally probably 8 different instances of Thinkorswim running on demand and back test, I hope, at least 100 trades, just like Tammy and Dale do. They back test everything in detail. Tammy gave me a spreadsheet, which I was like extremely pleased because she's way better in Excel than I am, and so I'm ready to go on beating the heck out of back testing credit spreads. All that left me wanting in terms of oh gosh, I'm way behind on getting my last meeting that we had, and I fell short. And I explained that to Dale. He said, hey, just focus. And that's exactly what I intend to do to get my testing going. And that'll leave me the time. If I get my testing going, it'll leave me the time to catch up with you guys and kick Jamal's butt on the
You guys
trade
got some catching up to do, right?
Yes, sir. So that's my report, basically.
Thanks for that.
Have any of you guys ever used the candles called Haikin Ashi?
Mm-hmm.
I did for a while, yeah.
Yeah, they're awesome. I've been doing a lot of study on them lately, and it's changed my game.
Nice.
Interesting.
Well, I'd love for you to kind of put together and teach us what you know about that.
Yeah, for sure, definitely.
Sometime. A couple comments. One, Greg, are you aware that you can set up a one-on-one demonstration for TOS?
Yes. I had one a while back, and now I have another one on Friday.
Okay.
So that's tomorrow. Yeah. So I look forward to that.
I was trying to find somewhere. I had some statistics on the amount of trades that SPX is as a component of the market. And it's amazing what percentage. I mean, it's a vast majority of the trades go through SPX. So it's a huge instrument.
Wow.
Yes.
Play. Yeah. I was trying to find it. I was going through Slack. I remember I posted it somewhere, but I can't find it real quickly. So,
but why doesn't SPX have a volume component to it? I thought that's kind of weird.
I was unaware that it didn't.
Yeah, I was on the phone with Toss. I'm like, oh, I just want to put the volume on my chart. Where is it?
Yeah.
Well, it's not that type of instrument. I'm like, what the hell? But it's accumulation of.
Well, I'm sure it has the volume of options, but you cannot own SPX. You can't go long the underlying. It cash settles.
That's correct.
And that's the reason why, they don't have volume for the underlying, but there are volume for options at each expiration.
Yes.
Well, I've been doing a significant amount of scalping, and all people used to say when I tell them what I do for a living, they go, "Oh, you're a day trader," and I go, "No, I'm not a day trader." But now I've added that to my repertoire, so I can no longer make that denial. I was trading during the election, and I was up till 3 a.m. just trading it.
That's amazing.
Yeah, and did well, doing that. So anyway,
what instrument were you trading, and what strategy?
I was trading the futures. I was trading /ES, the S&P futures.
Were you trading options on that, or were you trading
no, I was trading the underlying.
Oh, I'm proud of you. Awesome.
And I was going both short and long. So I was playing both sides of it. So there's times where I'd go long, and I'd ride a wave, and then I'd go short. And then there's times where I just saw it bouncing around, and I created a range, and I'd go, when it was a bullish range, I'd go long, and then I'd catch it at 2 points. And it was just popping back and forth all night, making 2 points. And when you're trading the ES, every 2 points, every tick is $12.50. So you can take $12.50 and multiply it by 8. What's that?
Yeah.
$100, $12.50 times 8 is $100. So every $2, you're making $100. So it's a huge underlying /ES.
Can you show us how to do that?
Well, I could show you how to do it. I can't show you yet how to use the signals that I'm using because they're not public. And so as soon as
how did the signals work for you, Dale? Did they work well or?
Well, I tell you what, for me, it's kind of like learning how to play poker. So you kind of have to learn how to use the signals. And when I first started using them, it's like I was playing poker. I wasn't doing well. And then you kind of like gamification. You got to figure out, is it better for me to jump a wave and try to surf the wave? Because a lot of times my analogy to surfing, and I'm not a surfer, so I may be completely botching this up if you're listening to us on YouTube, but a lot of times I'd try to catch a wave and it wasn't a big wave, or all of a sudden it would reverse and I'd have to get out of it. So there's so many losses, maybe 1 out of 5 would end up being a wave worth surfing. And, you gotta, so I wasn't really able to make it much there, but where I made up for it, what I realized is that things, when they're going up, they don't go from point A to point B. They go like this.
Correct.
Right? So I thought, rather than try to catch a big wave, let me just take these $2 moves. So let's say I've determined it's a bullish trend. I'm just going to take profits at every $2. And then when it changes, I'll create another range, buy and sell at $2. So it's like $2, $2, $2, $2, $2, so that way. And then if it changes, I'll go bearish, you know, and I'll start shorting it. So the same kind of thing as it trickles down. So it's kind of hard to explain, but I promise you guys on our development plan, way down the road, are Pong signals. But I got to wait until these things become available to the public, because I'm a part of a select group that's testing it. And what it's almost like a research and development department. And we can't give out the vaccine until we've proven it, figured it out, tested it ourselves, determined rules around it. Because if I just kind of throw it out there, I'm not able to give you any kind of structure really on how to use it, because that's really what a small group of us are figuring out.
So when you don't have any volume to back it up, how do you know when buyers are coming in or bears are coming in?
Well, for every buyer, there's a seller. So that's
on ES you do have volume, Jamal. There is on the SPX.
I was what about SPX?
Well, there's no volume on the underlying because you can't own it, but there's volume on the options.
Gotcha.
That you can check. But yeah, so I have put together, and I don't know, Greg, have we lost you?
No, just a second.
Okay, I thought maybe you knew that the test was coming. You thought you'd opt out.
Answering my wife, sorry.
Okay. All right, well, here I have put together some trivia questions. And here I want you guys to individually write down your answer. That's a way, rather than kind of shouting it out, this is a way I make sure everybody participates. So I want you to write down, when you sell a naked put, what do you hope happens to the stock by expiration? That's your trivia question. Do you A, hope the stock goes down? Do you B, hope the stock goes up? Do you C, hope the stock stays unchanged? Or D, both B or C? All right, so everybody write down your answer, including you, Nancy. I know we're not looking at you, but you're on your honor.
Okay.
Write down your answer. Everybody have your answer?
Yes.
All right. Nancy, what did you write down?
A.
A, the stock goes down. Jamal, what did you write down?
B.
B, the stock goes up. Greg, what did you answer?
I put it in the chat. I put D, but I'm not sure about that unchanged.
The correct answer is D. You hope the stock either goes up or it remains unchanged. So Greg is our big winner on this one.
Because you're collecting premium, so you want C is also good for you. I forgot about
C is also good for you.
Yeah.
That's
now,
right.
Remember, Nancy, selling a naked put is a bullish strategy.
Yeah, okay, I forgot, yeah.
Yep. And
because we're selling, that's why I got confused as well. And we're selling we're getting the premium.
Yep.
Yeah.
But C, I mean, D is the correct answer. So you hope it either goes up and then you thank you very much for the premium. Cha-ching, I'm taking it all the way to the bank. We'll see you again next month. Or unchanged. And unchanged, you still get to keep the premium. Now the bonus question now. Explain how the stock could still go down and you could still make money on selling a naked put. How could that happen? Does anybody know?
If the stock goes down where it's not going down more than what you're collecting in the decay.
Exactly.
Yes, correct.
Exactly. So it's like you've collected rent money, but if the underlying of your home doesn't go down more than you've collected rent money, then you haven't lost money. You've still made money. Make sense?
Yes.
All right. Second question, trivia question number 2. When you sell a naked call, what do you hope happens to the stock by expiration? A, hope the stock goes down. B, you hope the stock goes up. C, you hope the stock stays unchanged. Or D, both A or C.
Do we put it in the chat?
Sure. All right. You got your answer, Nancy?
Yeah.
You can't look at Jamal because he just flashed it. That would be cheating. What's your answer this time, Greg?
I picked D again.
D again. Jamal?
D as well.
D as well. Nancy?
D.
D. Great. You guys are learners. Now explain how the stock could go up and you could still make money on selling a naked call.
Same as Jamal said. Yeah.
Yeah. It has to go up less than what you collected from your call premium.
Exactly. Yeah.
All right, good. Now, can you see how there's multiple ways to make money and you don't just have to be right?
Yeah.
What a liberating concept to be able to make money and be wrong. I mean, isn't that great? Where else can we get away with that?
Can you see the difference there, Dale, as you traded futures? It's an amazing difference that you're talking about in stress level that Jamal mentioned.
Yeah, you have to be right. You have to be right when you're trading. And that's why, it's frustrating, but it's challenging. And it's not the only thing I do. So I would say have like a whole, all the tools in your toolkit and play with all of them. Find a playing style that fits you and fits your stress test and is the kind of appropriate, because there's certain kind of YOLO players like, Quan, or somebody who's just, that's all. And I'm nothing against that. That may be all. I mean, Quan doesn't like to keep anything overnight. That's just kind of the way he trades. And it's just not, it's not my only playing style. I would rather own a casino that's churning out cash, and making money, and I don't have to be right. And that's a core. And I'd like to do some other things around that core. One of the things I'd like to do occasionally is put on some trades, take a shot, around trading around that core.
Yeah, I like that idea.
That's just me. So, okay. Another trivia question. When you sell a strangle, what do you hope happens to the stock by expiration? A, stock goes down below the put price. B, stock goes up past the call price. C, stock stays unchanged. Or D, A or C.
C.
Say C as well.
C.
Yeah, stock goes unchanged. Bing, 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 bing. So now the question, explain how the stock could go up or down and you could still make money on selling a strangle. How could that happen?
If it doesn't go up, if it stays within that range. So, for example, like my trade if it stays between $40 and $50, I still make money even though I bought it at 45.
Yeah. If the total premium collected exceeds whatever the loss is from going past that put or call. Yeah. Good. So now,
and Dale, you should be able to see that on your chart, right? You should be able to chart it and see it.
Yep.
Yeah, that's key
Exactly.
to me.
Now, and when I say the total premium collected, because you may choose to make an adjustment. Remember, I think it was last time we talked a little bit about when it goes past that put side or breaches the put, rolling the call side, turn it into a straddle. If it breaches the call side, rolling the put side up and turn it into a straddle. So now you've sold premium on 3 different options. So potentially you could still grind out a small win or scratch, and you could take a 70% win rate to 75 or 80 because you've managed it correctly. Has anybody had any strangles that have gone against them?
Not yet.
Or you have?
No, not yet.
Not yet? Okay.
Dale, did you just mention that as a general rule, if you're in a strangle that and it goes against you on one of your sides, that you can turn it into a straddle?
Yes.
When that happens?
That's my first line of defense, is
Okay.
to turn a strangle into a straddle. The second line of defense is to go inverted. Inverted means where one side is further out than the other side. So theoretically, your call side could actually be higher. I mean, be lower than the put. It's kind of hard to explain without giving you a demonstration. It's easiest if you guys have some real trades that have gone against you. Maybe we should kind of take a look at a few of those. Anybody have toss up?
Yes.
You do, Nancy? All
Yeah.
right, let's take a look at a few. Let's look at Nancy's. You guys, I'm not sharing my screen yet anymore. I'll share my screen here with you. Let's look at Nancy's portfolio here. She's got an IWM strangle. You know, I don't see anything in here that kind of needs to be adjusted. Do you guys have any? I already asked this question, I know, but have you looked at your portfolios to see if there's anything that possibly any of your strangles that might need adjustments?
No.
All right. One of the things I would encourage you to do, see over here where it says 37% percentage of in it, Jamal, what I like to do is to take this baby off anytime it gets to 50% or lower.
Okay.
And then you're just starting to book profits. I also like to take off kind of naked puts when they get, see, you only have 3.5% of the juice left in this lemon on Snapchat. See, so you're taking more risk than probably what 3.5% is worth.
Okay. So, so what is this? Can you explain the percentage of in it?
Percentage of in it. See, what happens is you've got an initial amount that you collected on Alibaba, which is $1,132.
Yes.
If you closed it right now, it'd cost you $920 to close it. So you've captured 80% of the initial value. So if you hover over it, it tells you it's the percentage of the initial value that your trade is now worth.
Okay.
So anytime this gets to 50% or lower, Tasty Trade always advocates that you take things off at 50% of max value. Now that assumes that you're an active trader and you're always coming up with opportunities. If you're not, if you're working hard and you know it's a struggle for you to come up with ideas, you might want to just go ahead and wring out that last 5%. On the other hand, if you're like me, I see more opportunities that I can take advantage of in terms of my buying power. So I'm always it's almost like inventory turnover. If I've got a convenience store, I want the inventory turning over a lot regularly. That
so
means
anytime below 50%, it's time to get out.
And the reason is that affects your variability, variance. Jamal knows playing Omaha, you have more variance than you do playing Texas Hold'em. Variance means what your swings are. And if you're taking profits at 50%, you'll see that your swings are less. Our goal as a trader is to make consistent income without this kind of thing.
I hear you. I struggle a little bit with, well, gosh, when you get past the 50% zone, you're closer to your expiration, and therefore you're going to be moving faster toward your goal.
It's going to speed up. Yeah, that's one thing you do potentially give up a little bit, but you're also having increased risk.
Yeah, you're right.
So,
if you on my page, if you see the Oracle trade on the bottom, so it's at 57% right now. So pretty soon, it's better to peel that off as well.
Yeah, here's what I do. I keep a list of things that I'm bullish, bearish, or neutral on. And then when something goes down, I like to sell a put in something I'm bullish on. If something goes up in any of my bearish lists, I like to sell a call on something that I'm bearish on. So I'm always moving in and out of kind of these kind of list of things that I'm bullish or bearish on. Then I've kind of got a thing that I'm just neutral around these things, but they tend to have pretty high volatility. These are kind of things I trade neutrally a lot. So Jamal, you had a question here. What was it?
I was saying the Oracle trade, all the way on the bottom, the iron condor.
Yeah.
Is it going to be time soon to just?
Yeah, you got 7% left. I mean, if that's your rule to take things off at 50% of max value, you got 7% more of this lemon juice that could come out.
Okay.
Hey Dale,
and see what you're always doing is you're capturing some dry powder too. Every time you're taking these things off, if volatility were to skyrocket tomorrow and you've taken a lot of these off, you just got a ton of dry powder and you're like a kid in a candy store, baby.
Dale, how often are you updating your bullish, bearish, neutral list?
You know, when major things are happening in the world that cause you to view things differently. I mean, you're just kind of, you know, you may have an outlook based upon, you know, you read a lot, Greg, and based on an election, you know, or what other people are saying, and you're taking in this data and you're reading and you're like, that makes sense to me. You know, I kind of like to own this for these reasons. Well, put it on your bullish list.
Right. Okay. Because I was like reading about cruise line today and going, well, maybe that bearish idea is a good idea. You know,
I personally like dominant brands. I like things that have a moat. I like things that spill off cash because I kind of like to look at stocks the same way I would look at buying a business, but that's kind of Warren Buffett of me. I'm not as much of a speculator or a cult-like following. I want to look at their fundamentals and say, are they spilling out enough cash to buy growth companies?
Yeah.
You know, I like things with a moat around them. What is a moat? It means that if you, it's a Warren Buffett term. If you gave me the market cap of that stock, could I compete with them? You know, and it's hard to compete against a brand like Nike or Starbucks or McDonald's or Apple. You know, these are just dominant brands that tomorrow people aren't going to go, you know, I really loved my iPhone, but now I don't need a phone anymore. No, they're going to be, you know, you see them, people are just like addicted every time they can't go anywhere without their phone. So it's like a level of addiction that's built into a dominant brand. And I think that serves as at least a protection, especially for older guys like you and I, Greg. We kind of like things that have a moat around it.
Yeah. Good point.
What's it called? Like, we think like when you're talking about industry, like we think casinos are bearish right now. Like for example, when we believe like it's going to be bearish, like the COVID numbers are going up. Their earnings today was negative $7 a share, but then you see it go up like 4 points. Like how do you protect yourself against something like that?
Well, you protect yourself by having a diversified portfolio.
Okay.
So you've got plenty of other bullish things. And you might stay small enough given the size of your portfolio, but when I see something move up in something that anything where I have to brush shoulders in close proximity to other people until the thing you're up against is, you know, they may come up with a shot or something that changes everything. But until they do, I just know I'm not going to go hang out and touching a bunch of poker chips, you know, around a lot of elderly people, you know, playing those slot machines. You know, if I'm 80 years old, you know, the last thing I want to do is go in and be rubbing shoulders in a cruise ship. You know, I just try to kind of think like I would think in that thing and say, are there significant part of other people that would be the same thing? If so, it's kind of a dominant thing that's going to make their business difficult. But that's just me. And the way I have plenty of other bullish positions. It's not like I'm a super bear.
One of the things I didn't understand you said, Dale, was you commented about neutral, and you said, I think you said high volatility neutral.
Yep.
That doesn't make sense to me.
High volatility neutral. It means that this is something that I like to play neutrally, and it tends to be a high volatility product. Now, let me give you here's a list of liquid ETFs, and I sent you guys something that you could download on your Thinkorswim, right? And I also did the same thing for Sosnoff setup. So what I can do is I can scan for implied volatility or IV percentile. Now, the difference is IV percentile is it compares its volatility against itself. So you can, like 100% is like it's more volatile than that underlying ever has been before. So, if I look here and I can do a scan and I can look through some of these, XOP, is at the IV of 55, which is pretty high. It's oil and gas, right? XOP is an oil and gas ETF. Well, if Biden gets elected and, it may be more sustainable energy, it's kind of different. So that volatility is priced into that underlying. On the other hand, if you believe it's still people are going to be buying gasoline for a long time, you might go ahead and be bullish on that. Personally, I tend to be more neutral. So selling strangles around XOP, would be a good thing for me. GDXJ, it's a gold miner. 50% IV, 18. The reason IV percentile is so skewed is because when COVID hit around March, there was fear in the streets. So it causes everything to be kind of IV percentile to be skewed low. Because at one time it was probably 80. So XOP, GDXJ, EWZ. See, these are things that I like to trade strangles in. So that just gives you a few. So if I go here into Sosnoff setup, so I go into my personal and go into Sosnoff setup. These are the underlyings that Tom Sosnoff, the founder of Thinkorswim, the founder of Tasty Trade, likes to trade most often. And I can go down here and look at some of the high ones. VIX is really not tradable, but Macy's right here is a 92% IV, and it's a $6, trades for $6.44. Why? There's a lot of fear in retail. I mean, a lot of retail are going out of business. Some people believe it, the malls are going to become ghost towns or whatever. I tend to be kind of neutral on Macy's. The downside is there's earnings coming up on November 19th, which is 14 days from now. If I'm going to trade something on earnings, I like to trade it the day before. Otherwise, I don't trade it ahead of time. At Tesla, 69% IV, if you can stomach the swings there. X, which is US Steel, that's a good thing, a good strangle candidate. Boeing might be a good strangle candidate. So these are all, what I mean by that is when I'm neutral on something, it means I'm not bullish or bearish on it. But when it's a high volatility product, I like to sell strangles. Now, you don't want to have too many of strangles because what's going to happen? What happens if it goes past your put?
Then you have to turn it into a strangle.
Turn it into a straddle?
Yeah, straddle. Like, roll over the option that hasn't moved.
Yep. The danger is if you have a whole slew of strangles, and everything goes to the crapper, and everything's hitting all your puts and you don't have enough money in your accounts to take possession. You know, it's like all of a sudden, so you don't want to have too many.
Okay.
So, you know, I would say one strangle probably per 20,000 in an account.
Oh, wow. Okay.
It's probably, and once again, you could change the size of it. If you're doing one lots, you know, you could do one lots, you know, one strangle for every 20,000 in an account. You know, you get to 100,000, you could do three of them at 3 lots. You know, you get to a $250,000 account, you could have 4 or 5.
So when you say lot, you mean 100 or 1,000 shares?
You're one contract.
One. Okay. One. Because I know like some Wall Street traders like to consider one lot 1,000 shares.
Yeah. Let me show you an example. And I trade my nephew's account, and he is a dentist and he doesn't have any time, but, and I'm still sharing that screen, right?
Yeah.
He started with $10,000, so it's a small account, and I'm
No,
trading.
no screen share.
No screen share. All right.
Very good.
Thanks for letting me know. I started with $10,000 in his account, and it's really, he can't trade anything naked. It's just too small of an account, but I've created 2 iron condors, one of them in QQQ and one of them in GLD. I traded 3 contracts in GLD and 2 in QQQ. And I want to say, you know, it probably cost maybe $2,000 in buying power for those two iron condors. And, you know, if I come over here and I look at Theta, he's collecting $14.62 daily in Theta decay in a $10,000 account, which is not huge, but, you know, you got to start somewhere, right? And, you know, my goal is kind of, as you look here at ROI, and I've got a core investment here, but look, he's done 32%, where NASDAQ is at 24 and S&P is at 15% since June.
Now, how do you look at that percent of initial on that?
Well, percentage of initial is most meaningful around a specific investment.
Yes.
Like that.
Yes. Okay.
And then if I go here and I show you, and this is something you guys can do also in your contest, you can do your ROI, you know, your projections. And then I can do an ROI projection here for his account. And it can show you each month kind of what his return has been. So I had a drawdown of 8% in September, but I've averaged 5.48% per month, which is a little over 60% annualized since June. So you can kind of see, you know, for this young guy, if he sticks with it, you know, in a $10,000 investment, could potentially in 10 years have almost $6 million. Now, I don't think this is sustainable. I'm not going to go out there and advertise that I can average 5.48% per month. But if you could, that'd be cool, right?
Thanks. Absolutely.
And if anything, hopefully it kind of motivates young people, the importance of starting out young. You know, people always say, how much do I need to get started? And I say, whatever you got. You got to start with what you got.
Dale, which channel is the watch list that you sent, the Sosanoff setup thing?
I can post it again in the Slack group. If you can't, I think I put it in the shared file folder.
Okay.
It should be in our Zoom, but I'll purposefully put it again in Slack in case you can't find it.
Thanks, man.
You're welcome. All right. Well, it's 5:38. I know we kind of got a short start. I want to keep these to an hour. Any other questions you guys have?
No. Just one question related to what you were telling us in the beginning, how every tick is worth $8. There's a thing.
$12.50 in S&P ES futures.
Yeah. So
Okay.
what do they mean by tick, and
Okay.
where, like, is it on a 1 minute chart, on a 5 minute chart?
Okay. /ES futures. It moves up in 25-cent increments. So there's 4 ticks to $1.
Okay, I see. Okay.
So $2 is 8 ticks. Every tick you make $12.50. So it's basically, if I'm trading with the goal of getting $2 on every one of these trades, it's $100. I've negotiated my rates down to, just really started actively trading futures, but it cost me about a couple bucks. There may be some other little fees too around there for futures.
Had you thought of trying to trade the MES versus the ES just for?
I have, but they're charging me the same thing for MES at $2. And, when I'm kind of trying to move in and out of it as much as possible, an in and out $4, versus an in and out of $8, 8 and 8, 16, So if you have to, given your account size, trade MES. If you've got a big enough account, and you can take and trade ES, it's just kind of transaction costs is one of the things that, it hurts me to pay that much transaction costs for MES.
Have you ever traded /VX?
Jamal could relate to this. It's like playing in a heavy raked poker game, an underground one in Dallas, where you see how much they're taking out of the table and you're like, I can't beat this game. Yeah. Well, it's kind of like MES with their transaction costs. Now, there are places where you can get a better transaction cost. TradeStation is one of them. I think Quan can get, 30 cents a contract to trade MES. So if that's all you cared about was transaction and it's easy for you to do, check into that. Hopefully in the future, I'm trading it so much now, I'll be able to negotiate rates. Currently, I'm getting 40 cents a contract on options, and can help all you guys, once you kind of get active, figure out how to negotiate with TD Ameritrade.
Gotcha. Sounds good. Because the reason why, because I had seen about /VX, because I used to trade TVIX. That was the only thing I used to trade back in the days before it got delisted. So I was interested in /VX and /VXM, and that is, I think, $50 a tick. So, but I didn't know.
And it's actually trading the VIX.
Yes.
I have not been able to successfully, and it may just be me, but your cost to carry of a VIX trade tends to be, you have to be so right on your timing. And if you're not right on your timing, it's hard to make money. And I have not been successful in trading the VIX. And from what I hear, I'm not alone. I think Tom Sosnoff, I've heard him say stuff similarly.
Okay. Yeah, I've not had good luck with VIX, but I used to trade TVIX really well, and it made me quite a bit of money back in the days. Yeah. I was pretty upset when they delisted it.
Right. Well, I know Quan does a lot of in and out trading. It sounds like both Greg and Jamal, you both are kind of interested in kind of being a trader too. And I am, I tried to make it work for me probably in 2000 through maybe 2005. Really couldn't make it a sustainable, replicable, reliable trade. And so I kind of let it go. And now I'm kind of back into that world by people who swear by it, and they're kind of showing me some things they're doing. But then I'm kind of taking what they're using and making it my own and trading it in maybe a non-traditional way to finally make it work for me. All these other people they joke, and that because I'm not paper trading and I'm just kind of jumping in and actually doing it for real. And they're like, oh, Dale, he's like a poker player, like, okay, I'm kind of like Quan did when he tells you that he learned how to play poker by losing 11,000, playing online or whatever. I'm kind of a jump in, figure it out, and then slowly kind of ramp it up.
That's a gutsy move, man, to be trading the election. I'm impressed.
Yeah.
Wow.
Well,
do you put a stop in or no?
No, I just kind of watch it, and if things are going against me, I get out. So what I really have learned is that I can play a small little $2 move. And it's funny, I'm buying it and it's already hit my strike before I can get the strike put in. So it's like go bling, bling, and I'll go in, I'll be putting it $2 away and it's already hit the $2. So I just mark it, boom, $2. It's like, wow, that's the fastest $200 I ever made.
How many cars are you trading on that ES?
I'm only trading one contract, but
okay.
I'm doing it in 4 accounts.
Yeah. Wow.
So it's like playing multi-table.
And you're doing that on Thinkorswim?
Yeah.
Mind-boggling. Because that's why I went to Ninja Trader. You can trade right off the chart.
Yeah.
And so it's
and there's kind of ways of doing that, and I'm not using trailing stops because I'm kind of trying to figure out. And so many times I was trying to catch that wave, and there was just so many bad waves that was just, and I was getting out when I would get in and it would completely reverse. By the time you identified it as a wave, I'd get in and then it was like, the wave was crashing. I was like, lose. So finally I was like, screw this. I'll kind of pick a general direction and then I'm going to play these $2. I play it bullish, but if it goes down, then I'd buy, and then $2 later I'm getting out, and then I'd set the range, and then if the range goes up, I move the range. So it's kind of like $2 range, $2 range, So I'm kind of like, but it's not something I want to teach yet because the jury's still out. I'm kind of in the process of figuring it out.
Yeah, amen to that.
Yeah. So, I lost in the beginning, and now I've made it back. So I'm now profitable doing it, but just slightly because I had some making up to do.
Mm-hmm.
So I'm hopeful.
The software that you said that you're using for signals, is it like an algorithm that you're following?
Well, supposedly it was created by some guys out of MIT. And one of the things that TradeStation allows is programmers to program in some signals. And there's like a ton of algorithms that's built into this thing.
Yeah, that's what I'm kind of working on. I have a friend of mine. He's a programmer and a trader as well. And we've been trying to automate trades.
That's cool.
Using like reverse areas.
Hold on a second.
Yeah. So
I have to go too, Jamal. I got to run.
Sounds good. Let's we'll chat another day.
Here's just a book that I finished reading, The Complete Turtle Trader.
Okay. Oh, wow. Congratulations. That's great.
It was, it was in the, I'm not sure what year, but it's a story of some guys that taught some other turtle traders how to trade, and they're momentum traders. And a lot of these signals are built around a momentum. So, it takes a while before it identifies momentum, right?
Yeah.
And so it's really set up so you really make money on big waves. Well, there were a lot of big waves around the election, and so that was it's almost like surfing during a hurricane. There's going to be a lot of big waves.
Yeah.
You see these guys, looks like they're on top of a mountain, right? It's like, God, it's crazy. And that's sometimes what it feels like when but you're kind of surfing but that's kind of what these signals are based on. And then I'm trying to kind of take some of them and adapt them to what I find, because there were so many that just didn't end up being a big wave. And I'm like, how can I make money even when I'm not catching the big wave? And that's where my $2 kind of experiment has so far been working. So you identify the general wave, which is up or down, and you're still playing it, but you're playing it at $2 increments and not trying to play a big move.
Gotcha.
Okay, so boom, it's a bullish trend. Let me catch it at $2. And then all of a sudden it's kind of changed, so you adjust your $2. And you're
So
just
you're
kind of like
adding on to your position, or you're
you're like taking things off.
Okay.
But you've got in, and then in $2 you're getting out, and then you go, do I need to move the trend up or keep the same buy point that I had last time? And as it moves up, you're just kind of trickling up. And if it doesn't go back down to hit your buy point, you're like, okay, I made money, but I may have left some on the table, but okay, I'm going to cry all the way to the bank. So it's kind of like in poker. You're like, well, I could have made more. Well, shut up. You made money. Stop whining. So the goal is to kind of make money instead of leaving money on the table. So if it doesn't go down to hit your next buy point and you kind of miss it because it just kind of goes all the way up, you just like, all right, I'll catch the next one.
Gotcha. That makes sense.
So that's kind of the way I'm trying it. I'm not saying that's the only way to trade it. I'm just trying to find my own legs and my own playing style based upon trial and error. And that's why I'm not ready to teach it or anything else, because I'm still figuring it out. And I'm with a group of other people who've done this for years and are part of like a beta test group.
Gotcha.
But
I look forward to showing you or introducing you to the volume profile, Dale, sometime.
Yeah. I have tried to play around with that, and I think where that could be most helpful, Greg, is I've told you a little bit about selling iron flies, right?
Yeah.
And I think what's going to be helpful is picking your strike price for the iron fly. And I think where that volume profile could be helpful is picking the right. Because if you could pick, let me just say, I don't think it's possible to do, but let me just throw this out there. If you could pick where XPX is going to trade at the end of the day, you could just kill it. It'd be like the trifecta every day. Well, if you could pick a closing price. So I'm not saying you can do that, but if you could do it in some kind of an increment, I mean, that's kind of where that volume profile to me seems to show a good midpoint.
Yeah, you can also do, if you had Tammy, I'm telling you, you run stats on, and I've seen a guy do it, run stats on into a spreadsheet on open, high, low, close for, 80 years. And you run the stats on that, you'll see that there's some very, very interesting statistics that you can thus plan on. Well, if it didn't break this low, it's going the other way.
Yeah.
So,
I've added some volume profile, and Tammy will help me set it up. So,
I have to run, Dale, right now. I got to go out the door.
Okay.
But man, we should do another session sometime on that. It'd be fun to talk about.
Sounds good. Here's what Tammy's volume is.
Yes.
Oh, wow.
So that's kind of this volume profile. So you kind of look at the majority of the trades occurred above and below this line, right?
That's right.
Wow.
All right. Well, it's been a productive session, and
thank you so
thanks,
much.
guys. Enjoyed it as always. And
likewise.
Yeah, and post all your questions on Slack. And Greg, I promise I'll post that on there on Slack right now, so you can. That's that Sazonov setup and the most liquid ETFs.
I appreciate it, and thank you for letting me, I'm sorry for being behind. And
That's all right. Hey, Jamal, do you ever play Omaha High-Low?
Yeah.
Hey, guys.
We've got an online game tonight.
Oh.
If you're interested.
I might not be able to